So one of the next most common questions that I'll get, we're on number 4, our fourth and final question for today's video. How is my RMD calculated? This can be a little bit tricky, but once you get the hang of it and you're doing RMDs for a few years and you have a good advisor on your team making sure these things don't get missed, it's actually not too bad. Bottom line, the IRS bases your RMD on 2 key components. That's your year-end balance of your IRA or 401k, any of those accounts that I mentioned that you're going to have to take an RMD from at some point, and your age. It's pretty simple. Those are the 2 key variables. And each and every year you get a little bit older, the IRS makes you take out a slightly higher percentage. There's actually a table that the IRS has put together with a divisor for each and every year. And the first year divisor for your RMD is 27.4, okay? So stick with me here. I know I'm gonna hit you with an example, maybe a few numbers, but we'll move slow. So like I said, the IRS bases these 2 variables, how much your IRA was or 401k on December 31st in the previous year. And then of course your age for the upcoming year, all right? So if I'm trying to determine my 2025 RMD, the IRS is going to take a look at whatever my IRA balance was on 12/31/2024 and however old I'm going to be in 2025. All right. So let's use an example. Jane, she has a $500,000 IRA as of the end of December of 2024. Jane turned 73 in 2025. It's her first RMD coming up. That first year RMD divisor, as I mentioned, based on Jane's age 73 is 27.4, okay? So if you take that 500,000 and you divide it by 27.4, we arrive at $18,248 and some change, okay? That essentially ends up being that $18,248. If you then divide that by the $500,000 balance at the time, at the end of the year that we calculated from, that ends up being 3.65% of Jane's account. So it's a pretty small number, right? It's not a huge percentage. However, each and every year Jane gets a little older, that divisor changes. Okay? It goes down, so that way the percentage actually goes up. So IRS periodically will change that. They did so a couple years back because people are living longer. And so I would not be surprised at some point, maybe in 5 or 10 years, they change it again, maybe to have you take out a slightly less percentage. The bottom line though is most Americans out there actually need that money to live on in retirement. Like I mentioned, it's not a huge percentage of a client's overall retirement, retirement plan, right? 3.65%, not a huge amount. However, we have many clients who have saved very well. Maybe they have additional income sources through pension, Social Security. Maybe they had some old annuity income. Who knows, right? They might not actually need that full RMD amount. They might not need the full amount. Maybe they need, in that example with Jane, maybe they only need Jane needs 10,000, not the full 18,248, right? Or maybe she says, Nick, I don't need any of this stuff. What are my options? It's a great question. And I'm going to spend even more time in a separate video because RMDs are complicated and there's some cool strategies that you can do to mitigate some of the effect that RMDs can have on your tax situation. So I'll tease you a little bit. Some of the most commonly used strategies to help reduce that RMD could be something called the qualified charitable distribution. If you're charitably inclined and we want to gift money directly from your IRA to charity, that can help reduce the tax effect that RMDs can have on your overall financial plan. And then leading up to when you have to start taking RMDs, taking a look at partial Roth IRA conversions and shifting more money from your IRA to a Roth IRA, because as we mentioned earlier, Roth IRAs, there are no RMDs. And even at some point, if RMDs are required from Roth IRAs, any money that comes out of those Roth accounts, if you've had them in there, if you've had the money in there for the correct period of time, you're not going to pay any sort of taxes or penalties on those distributions that have to come out. So I'm going to spend a lot more time on those 2 topics in a separate video because we could certainly go into a lot more detail in the mechanics and how those functions.